Hello everybody, and thank you so much for joining our webinar. Apologies for the slight delay there, we just had a bit of a problem logging in, but let's get going now. Just bear with me while I share my desktop. Great. So hopefully you're able to see this. Please let me know if you're not. But what I just want to do is just quickly go through my disclosure, and then we'll get on to the fun stuff. So the information and opinions in this webinar, they're not for general information use, or they are for general information use only, and are not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. Remember as well, guys, all opinions and information contained in this report, they're subject to change without notice. It's been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient. Any references to historical price movements or levels is information based on our analysis, and we do not represent or warrant that any such movements are likely to reoccur in the future. Remember as well, guys, futures, options on futures, foreign exchange and other leverage products, they involve significant risks of loss, and they're not suitable for all investors. Also, increasing your leverage does increase your risk. Spot gold and silver contracts, they're not subject to regulation under the US Commodity Exchange Act. Contracts for difference for CFDs, they're also not available for our US residents, not because we don't want to offer them, but because of regulatory reasons. So let's get going. Let me put up my charts. Bear with me one moment. We're going to start here. Actually, let's start on this one. This is as good as any. Obviously, we've had, we're Tuesday now, and I'd be quite interested actually to ask you guys a question. Whether or not you think that gold is going to fall further, or if it could potentially rise from here. Whether or not you think this is a buying opportunity for gold, or if you think it could fall further. Just jot down a quick note either in the chat box or in the Q&A box, please, if that's possible. Ray's just said a good thing, made a good comment. What a mess on the charts. Indeed. We'll be looking at that certainly with a bit more detail. But if you just jot down a quick thing, Ahmed is looking for a further decline. Actually, quite a sharp decline there. So you're no gold bug. And Pan is looking for a consolidation and then potentially a pullback. And Ian, very volatile for a bit. I think you all have very good points, and you've probably got very good reasons to back that up. I'd certainly at the moment I'd be wary to go long, because I feel like it's a bit like catching a falling knife. But equally, I do think it's probably ripe for a period of consolidation. I mean, where we are right now. Sorry, just bear with me. Let me just get rid of something. Where we are right now, with this piece is actually quite. Where we are kind of with gold at the moment, we are in volatile territory. We haven't had such a large move to the downside, or move at all in the gold market since the 1980s. We're in an uncharted territory, and Pold has just said depends on the fundamental news. Yes, I mean there are a few reasons now why gold has done, or that it is hard to necessarily say why gold has done what it's done. There's obviously China data, there's concerns on Cyprus, there's risks that there's another quite compelling argument why gold has been sold, is that people will have missed the leg higher in equities. They're expecting a pullback in equities, so they're getting out of gold to go into high yielding assets at better prices. I think that also makes a lot of sense. There are a lot of reasons, and remember, you can't always neatly tie things up. You've got to go with the market, and this sharp sell-off yesterday, and the fact we haven't seen that since the 1980s, does suggest that the dynamic in the market has changed, and that one of the reasons for the sharp decline was on the back of maybe the makeup of the market, the fact that there's a lot of ETFs there, a lot of short-term money in there now, and that once they see the price go, it's very expensive to hold gold, and obviously the smaller the trader, the more retail the trader is, the more likely they're not going to be able to afford the margin calls. So always difficult. So this is kind of almost a bit of it's an interesting one. This is dollar rand. This is the daily chart. I looked at dollar rand maybe a couple of weeks ago after the Bank of Japan meeting, and it looks like it was failing to break above here at the beginning of April or end of March, and there was a much sharper decline on the horizon. Partly that was, of course, a move out of Japanese assets and into high yielding assets. So this search for yield, well, with South Africa having the third highest 10-year yields in the African and emerging market space, the South African rand was always going to be an attractive asset to hold. But obviously it's also very leveraged to the gold price, of course, because they are big gold traders. And what we saw was that sharp move yesterday all the way from kind of this nice double bottom here at 888 all the way back up to kind of 924. That's a big move for the South African rand. It doesn't usually move in such large, you can even just see really from the candlesticks here, it doesn't often move in such large increments, daily increments. Interestingly enough though, I still think the rand could have some way to go on the downside. Dollar rand could have some way to go on the downside. I'm looking for a break now above 925 to negate that view. So if we got down to 925, then just bear with me one moment. I think we could see maybe the top of this channel, but I still see us trading pretty much within this channel. But I do think if we don't necessarily get a break above 925, I think it's going to be hard for the bulls to talk this up. Now, obviously, it is going to be dependent on what the gold price does, but if things do calm down, then we could see another drift lower in dollar rand. So just a bit of squaring up positions, and we could get back to sub 9, 898, 888. Which is the bottom of this range, and is also the 100-day moving average. Looking at it just from a shorter term perspective, again, as you can see, nice sharp move higher yesterday, but we did run into this double top resistance here now at 925, and if we can't get above that, that's quite a bearish development. That suggests quite a bearish development for this cross, and is something that needs to it's something that we need to watch out for. The other thing, since we're on these high yielding currencies, and because obviously, high yielding currencies, they mean two things. Number one, high yielding currencies do tend to be associated with the commodity sphere. So when you get a broad-based commodity sell-off like we got yesterday, commodity currencies, that includes the rand, the Canadian dollar, the Aussie dollar, the Kiwi dollar, they do tend to get sold off. However, on the other hand of that, we're in a low yield environment, so the yield that they give us, or the yield that we get from the South African rand, we get from the Aussie dollar, we get from the Kiwi dollar, is also attractive. So it could potentially mean that we see some buying interest coming in. Let's take a look at the Aussie here first. Here's the Aussie. As you can see, we did fall yesterday. We did fall back kind of below 103. Basically, anything above kind of 102.50 is quite supportive right now. Let's take a quick look here. So yeah, there we go. That kind of 103 level, we saw a sharp move lower, but then we haven't been able to kind of climb back above that 103 level so far today. But we are below these kind of key or prior supports here, cluster of daily moving averages, which come in at kind of just below 104. So we did have a real significant move lower. I also want to show you just another way of looking at the Aussie dollar. In terms of kind of what the fundamentals from Australia, it's been quite difficult to tell really, because the central bank is kind of flip-flopping one way or the other. And they're very reactionary. The central bank is also very reactionary. So what we've seen instead is that the Aussie has really been moved by overall market dynamics, overall market risks, and positioning. So I do think it's interesting. Yes, we got a significant move lower yesterday, but it's not as significant on technical terms. When you look at something like the Ichimoku cloud, we managed to stay well above the cloud. That comes in now at 102.56. So that was what that 102.50 level I was showing you is the base of that Ichimoku cloud. The fact that we managed to kind of hold well above there suggests that people are willing to pick up and buy on the dips. And as I said, that's typical in a low yield environment, in a QE environment. People are they're still looking for yield. The hunt for yield goes on, and the Aussie is obviously a high-yielding developed market currency and other things. Just bear with me one moment. And is thus, is us bought up. Now, obviously, it is sensitive to what happens in the gold market, but if one expects the moves in the gold market not to be repeated going forward, then we could see, and we're not saying that we're going to see, a big sharp pullback and all of a sudden, the Aussie dollar is going to go back to where it was. We don't think that. We think it's still, this to me is still very much range trading. The fact we didn't get above 105.80, disappointing for the bulls, for sure. The fact, though, that we managed to stay above that 102.50 level really suggests that we are kind of, limited, that we are kind of moving, we are moving within a range, within a clearly defined range here. So the closer we get, sub 103, and we're picking up buyers, but then people aren't willing to push it above 105.80. Ahmed has just said the fall in the Aussie might be linked to China GDP. That is a very good point, and obviously that was also one of the reasons, assigned to why the gold price fell so sharply. The other thing that I would point out, the one thing I would point out though, is that the Aussie dollar hasn't actually been as correlated to Chinese GDP and to Chinese economic data in the last year. So, since the start of 2013, so this year. That is significant, and I do think, Ahmed, I think you bring up a really good point. It's something that's been, it's a traditional relationship. In the same way that the Aussie didn't move with the S&P 500, likewise it didn't move with China for most of this year. So that's an unstable relationship at the moment. However, what we did see yesterday, we did actually see the Aussie move in line with the S&P and China. So it doesn't necessarily mean that relationship has been rebuilt, but it means that it's, whenever China data comes out, you've got to look at the Aussie. And obviously the stronger the China data, the better it should be for the Australian dollar. But it hasn't, even strong data so far this year hasn't helped us get above that, the top of this range, which we think still holds quite well. Now, what about the Kiwi dollar? It's a big night for the Kiwi, and for New Zealand in general, because we have that CPI data coming out. So they only release their CPI data quarterly. The market expects a fairly weak level of CPI at 0.9% annual rate. The target rate for the RBNZ is 1 to 3%. Now, we tend to think that there's a chance that inflation may surprise on the upside. And that's largely because of, yes, one-off factors, rebuilding of Christchurch, also the drought. But we think that would have at least a short-term impact on the market. So as you can see here, the Ichimoku cloud chart is really, the clouds have narrowed quite sharply, which actually suggests that there's no real prevailing trend at the moment. That's what that means. When the clouds kind of narrow, as we can see here, it really means there isn't any prevailing trend. And I think that's quite a good point. We tried to break above 86, but we just didn't manage it. But yeah, we are finding fairly good support, just kind of above 84. So we're back. We had been, touched sub 84.84. Since then, we've made a nice little comeback. Actually, we're at 84.65. There is, just looking at it from an Ichimoku basis, 85.20 is our next major level of resistance. And then you've got to look at the annual high here at 86.76. Now, while we don't think we're going to get such a large, inflation, such a large surprise in inflation that it's going to cause kind of a more prolonged trend. We think there could be a bit of volatility tonight, a stronger than expected CPI rate reading could get us above 85.20 to 85.50, but then we think that sellers will come in. We just at the moment we just don't think there's much of a trend going on in these commodity currencies. There's a lot of jitters going on. I'm going to look at the oil price in a moment as well, and of course I'll go through the gold price. But that's kind of our key here. There's a lot of uncertainty in the market, so we think that the commodity currencies at the moment, they're not willing to be sold off, and there's a chance they could rally and they could end the year stronger, but right now we're just in a bit of no man's land with them. The other thing I want to show you is the euro quickly, because euro is obviously at the slightly riskier end of the FX market. Let's take a look at where we are today. As you can see, kind of very close to the lows of the day, and that comes on the back of some ZEW data which was just released and which disappointed expectations. Let's take a look now. At the I've done it again. My apologies. Let's just look at a candlestick chart. Right now we're still below the 50-day moving average. That's the purple line in this chart. That to us is quite a bearish development. That comes in at 130.80. That's now massive resistance level. For us, it's harder for us, the euro did get slammed yesterday. It's harder for us to get excited about euro. Purely because it does look to me like 131.50 is a medium-term top, and the recovery is, as you can just see, really, the recovery since March has been fairly strong, but it's petering out, and I just don't feel like the bulls are there to get us above that level. 130.80 and then 131.53. That's the 100-day moving average. They're going to be really, really key levels, and I think the fact of the matter is, after getting slammed yesterday, if we can't get above those highs that we put on Friday. Remember on Friday we had a strange day because we actually saw gold sell off, but we saw the euro do quite well on the back of weaker than expected economic data out of the US. So that is going to have an impact going forward. If we see further weak economic data, maybe weak inflation today, then maybe we'll see euro get above 130.80, but we're going to need a real push from the euro side of things, so maybe stronger European economic data, which we're not getting at the moment. In fact, we're nowhere near it, to get us above those kind of 130.150 to 60 highs that could really see another leg pushed forward. I'm also just going to annotate this for a moment. I just want to show you some fib levels. As you can see, the 38.2% retracement of the down move from February to end of March comes in at 131.10. So that's also another massive resistance, another massissive level of resistance, one that we just haven't been able to get above. These fib levels, they trigger algo charts. They also trigger, a variety. They can trigger a variety of trading activity. So once we got above there on Friday, that may also have triggered some profit taking, which just kind of exacerbated then the decline that we saw yesterday. And again, we really need to get above that level and then get above the 50-day, I think. Get above the 50-day, and then above this fib level at 131 to give us some bite, really, to suggest, to give us some momentum to move higher, back to those kind of 131.50 to 60, then potentially to 132.5. That's the level that we want. Until then, we actually think that any strength will probably be sold into. There isn't too much to be hopeful for. That ZEW just reinforces the fact that. Skipping the gym because, getting, failure to break above these levels just really suggests to me that momentum isn't on the upside, and the fundamental picture obviously not very supportive for the euro either. Added to that, the closer that we get, I think, to 134, the more likely it is that the ECB will come in and maybe start talking down the euro. They've already expressed some concerns. The Bundesbank, for example, have as well. So that's kind of a key thing to point out. We think any move, just to reiterate our position then, 131, any move towards kind of 130.80 to 131 today could potentially meet a wall of short-term selling pressure. Buyers are coming in though. They are picking it up just above 130, but we think these are quite short-term charts. And again, it kind of a bit like the Aussie, a bit like the Kiwi. We're just trending sideways just for now. The pound as well I want to show you before I move on to commodities, and I know that a lot of you are interested in that. Again, got slammed yesterday along with the high yielders, but look at this, a double top here, 154.25. That for us is very, very significant. I also want to do the retrace the fib levels here, that was important. This 38.2 comes in at 154.25. That's exactly where that double top was. That has held. These levels, again, the prospect of more QE coming out of the UK. It's a big data week for the UK, actually. Tomorrow we've got labour market data. We've also got Bank of England minutes. And then later in the week we've got retail sales. All of this is going to be really significant. It's going to be very significant for... It's going to be very significant for cable traders going forward. Obviously, we get closer and closer to that May meeting. May is an inflation report month. There's expectation that they may do QE. They tend to choose to do QE when there is an inflation report meeting. All of this, is potentially, it makes the bullish case for the pound quite difficult. So where do we go from here? Well, we think this is it. Narrow your time frames. If you want to trade on the back of economic data, we actually think that it's better as a sell. We wait for a little bit of strength. I mean, the high today has been, let me just double check that. I don't want to give you the incorrect information. Actually, those of you who, I probably shouldn't promote other websites, but Forex News actually, and actually on our forex.com website, we also have, we will have a pound trade there, just a pound idea that you may like. But basically, yesterday, the high that we reached in the pound, which was met with kind of some selling, has been kind of 153.80. So any strength, we're currently at 152.95. We've seen it kind of just weaken a little bit on the inflation data that was out later, that largely inflation stayed where it was expected to stay, at 2.8%. So again, didn't kind of rule out the prospect of more QE for sure, and that's just weighed a little bit on the pound, but we think it's going to kind of trade sideways. Any strength will be sold into. So it's a patience trade. Wait, we think that certainly the closer we get to 153.80, then potentially even to 154.25. If we get above 153.80, then 154.25 could knock the bulls, but we'd probably, if we get above 153.80, we'd wait till 154.25 to kind of initiate a short, because we think that's going to run into a huge wall of resistance. There's a lot of orders there. That's what we've been hearing. A lot of sell orders, a lot of take profit level. It just doesn't seem like either the UK economy or the fundamental data is strong enough now to withstand kind of a stronger retracement there in the pound downtrend from February to the end of March. The other thing, let's look at gold. Why not, hey? Gold's been seriously significant. It's dominated. It's less dominating. This is today. I mean, you do not see candles like that often. So look and embed them in your mind. This is a little bit of market history. Those of you who were around trading in the 80s may have seen it, but you probably weren't trading like this. So it's an interesting thing. I'm going to have a chart that goes all the way back to the start of 2011. Now, because that's really leaving us where we are. I did find interest. The low on the 28th of January 2011 was 13.08, and the low yesterday was 13.22. So it does suggest that as we get close to the 1300 level, the market is willing to respect it. Now, a pullback today was always going to be on the cards, absolutely always. In fact, the pullback has been quite sharp. It's been a $50 pullback. We could even get $100 pullback. We could get to kind of 14, get back above $1,400. We absolutely could, and that's because there will be bargain hunters coming in looking to pick it up, just even on the short term, thinking that it will rise, because you don't see moves like this. Moves of like $150 in a couple of days, they're unsustainable. $150 in one day, as in yesterday's experience, they're unsustainable, and those pace of losses don't last. That's fact. They don't last. You're not going to see another $150, then another $150. So that's why we're seeing people come in and really feel like they are picking up bargains here, and that's why we've seen this kind of pullback. Also, always be wary as well of these. I know these candlesticks do look strange anyway because they're just so extended. Always be wary though of long shadows, and that's what we got towards that 1300 level. So it suggests the market did try and dip it back there, but that's when the buyers came in. So certainly the short term, a low has been put in around about that 1320 level. In terms of where could we really go next? There's a few things that we're going to be looking at. The Ichimoku doesn't really tell us too much because obviously it's lagging. Let's take a look here. Again, we've moved so far. I mean, you've got to really think about kind of the whole numbers. Obviously 1400. I'm also going to bring up a pointed figure chart. Those of you who've joined these for quite a while will know, we do like figure charts here. And really, you've got to look kind of at the intraday. You've got to, at the moment, if you're a short-term trader in gold, maybe looking to pick it up on the short on the pattern. Keep your time frames quite short. That 1300 levels is going to be respected, right? It's a significant level. It dates back to 2011. There's going to be a bit of nervousness, and right now it looks like it's holding. These, as I said, there's different reasons why it might hold bargain hunters, but also the fact that it's coming down. So, where would you look for a pullback, and maybe if you want to establish gold shorts, but you might have missed yesterday's move. 14.25 is what you'd look at, and then kind of 14.95, obviously a significant level, and 14.55. These are kind of your incremental resistance levels that could be met again with some more selling pressure. Today, as you can see, we haven't really managed to get above 13.80. That is significant. A close below there suggests that we could be on hand for kind of, maybe another test of that 1300 level. But we do think 1300 will be quite sticky. Between kind of 1310 and, even up to kind of 1450 is where we could consolidate. But we definitely think there's consolidation there for now. I'm going to take a look at the yen as well. So the yen has been interesting. The Japanese currency, it attracted safe haven flows yesterday, but it also there was some economic data there that was better than expected, and that really helped the yen. That really helped kind of just accelerate this dollar yen down move. Interestingly enough, again, a bit of a long shadow there suggests that this morning we tried to push it lower, all the way down. Let me just get the exact figures for you. We tried to get down below 96 at one point, but then that's when we saw the buyers come in. So right now, in terms of the Japanese yen, it's going to be important the next couple of days. We've got some economic data out of the US. We've got CPI coming out today. We've got some housing data. Then we also have, again, some housing data into the end of the week, and of course those initial jobless claims. I think because of the market was so kind of shocked and startled by what happened yesterday, we've actually seen, dollar yen did a bit like gold, really. It overextended itself. You often do see commodities overextended themselves. Well, dollar yen, that's also in the spotlight. We know there's a lot of interest in it. That can also overextend itself. So right now we're back above that 97 level. This takes us a step back, obviously, from 100. What we're looking at now is just for a move back towards this kind of 98.70 level. So 100 pips from where we are now. If we can get a daily close above there, maybe not today, but at some point this week, then that's a positive development for this cross. I mean, still, from a monetary policy perspective, we still think that, the Bank of Japan is going to, the Japanese policy stimulus is much more kind of, negative for dollar yen than not negative for the yen in the more medium term. But in the shorter term, we may struggle to get back to those kind of 99.70 highs that we saw last week. There's just one last chart that I want to show you, guys. Just bear with me one moment. I'm going to show you this chart here. Just bear with me one moment. This is dollar yen, and then it's Japanese government bond yields. And as you can see, they usually kind of move in essentially opposite directions. So you see rise in government. So the orange line is government bond yields. So when you see government bond yields in Japan fall, that usually means a stronger dollar yen. That makes sense, right? Because that means the dollar's got the yield advantage. But what we've seen recently is as the yen, it was actually last week as well, as the dollar yen made that move to 100. It wasn't following with the normal relationship with yields. So what we saw was Japanese yields actually move higher. And that also was maybe a precursor to dollar yen coming off. So what I'm basically saying is look at your lead indicators. There's a lot of political interest in markets right now. There's positioning, and central bankers have a massive point, and you need to look at your indicators. So I would say with dollar yen, it looks like we've put in a bottom, certainly a temporary bottom anyway, at 96, but it's 98.70 that we need to get back above to have any real chance of getting back to 100. We think we'll get there, but we think right now now the market is saying we're going sideways until the market sorts itself out, combined with rising bond yields in Japan, which often happens after big QE stimulus announcements. Added to that, we've also got we also have some we also have kind of, risk aversion in the markets. That is kind of not necessarily going to be the right circumstances for dollar yen to rally, but it's certainly one to pick up on the dips, we think. Okay, everybody, I'm going to have to end this now. I'm over my allotted time. But thank you so much for joining. Please do join us next week, and I promise I'll get to answer more questions. Good luck trading this week, and hopefully you'll join us tomorrow for more. Thank you.